Imagine you walk into a bank tomorrow and they tell you the dollar in your pocket buys 30% less than it did last year. You would call that an emergency. But what if that process was already underway and nobody told you? While you were watching the news, 10 nations representing half the world's population quietly minted a new currency. It is backed by physical gold, it settles trade without a single dollar, and it went live on October 31st, 2025. The map of the world just shifted, and while most are looking at the headlines, the real story is happening inside your bank account. Welcome back. What was quietly launched at the end of October 2025 is a prototype settlement instrument called the unit. It was created by the International Research Institute for Advanced Systems and built on distributed ledger technology. The unit is not a national currency. It is not designed to replace the dollar in your wallet or the yuan in a Chinese factory. It is designed to do something far more consequential. It is a cross-border trade settlement tool backed 40% by physical gold and 60% by a basket of currencies from the world's fastest-growing economic coalition. And it just moved from theory to operational pilot. The invisible tax of inflation is moving faster than the news cycle. While the world watches trade negotiations and political statements, a parallel financial system is being assembled in real time. The cost of not understanding what is being built right now is not theoretical. It is measurable, it is structural, and it accelerates with every quarter that passes without attention. Here is what makes this moment different from every previous discussion about dollar alternatives. In the past, nations talked about reducing dollar dependence at summits and in joint statements. Nothing changed because talking is not building. What is happening now is building. Concrete, measurable, verifiable infrastructure being constructed across 4 continents simultaneously. The difference between rhetoric and reality is now visible in the data. The United States national debt currently stands at over $38 trillion. It is growing at a rate of approximately $8 billion per day, or $92,000 every second. The annual cost of servicing this debt has crossed $1 trillion. For the first time in American history, interest payments alone exceed multiple major categories of federal spending combined. The Congressional Budget Office projects that federal debt held by the public will reach 120% of GDP by 2036. Under more aggressive modeling, some analysts project 131% within the same period. Economists have identified a critical threshold where the interest rate on government debt exceeds the rate of economic growth. When this line is crossed, debt accumulation becomes self-reinforcing, and no amount of growth can reverse it. The CBO's latest projections indicate this threshold will be crossed later this decade. This is not a political opinion. It is a published mathematical projection from the official budget office of the United States Congress. These fiscal realities are not abstract numbers on a government website. They are the precise reason why central banks around the world are building alternatives. The unit is a direct response to this arithmetic. To understand why the unit matters, one must first understand the problem it was designed to solve. For 80 years, virtually all international trade has been settled in dollars. A factory in Brazil selling soybeans to China needed dollars to complete the transaction. An oil producer in the Middle East selling crude to India needed dollars. A mining company in South Africa selling platinum to Russia needed dollars. This meant every nation on earth needed to hold large reserves of a currency they did not control. It meant every central bank was exposed to decisions made by the Federal Reserve and the United States Treasury. For decades, this arrangement was accepted because no alternative existed. The dollar had the deepest capital markets, the most liquid bond market, the most trusted legal framework. The network effect was self-reinforcing, but the arrangement also created a structural vulnerability that became impossible to ignore after 2022. When a major international financial dispute led to the freezing of over $300 billion in foreign central bank reserves, the vulnerability became a demonstrated fact. The message received by every national treasury was unambiguous. Dollar reserves held in foreign institutions are not unconditional property. They can be frozen, restricted, or revoked based on policy decisions made by the host nation. The coalition of nations, now developing alternatives, did not begin building this infrastructure out of ideology. They began building it out of self-preservation. The unit is one component of that broader effort. The technical architecture of the unit is designed to address every structural weakness that has prevented previous alternatives from gaining traction. Previous attempts lacked either the economic scale, the commodity backing, or the technological infrastructure. The unit combines all three. The 40% gold backing provides intrinsic stability that no purely digital instrument can offer. Gold does not inflate, gold cannot be printed, gold cannot be frozen in a foreign server. The 60% currency basket includes the 5 founding currencies of the coalition, equally weighted. This provides liquidity for large-scale commercial transactions, while preserving the monetary sovereignty of each participating nation. The settlement mechanism operates on distributed ledger technology, enabling real-time cross-border transactions without routing through traditional correspondent banking networks. This means transactions do not pass through any system controlled by a single nation. Each participating country holds its gold reserves domestically in escrow accounts on the ledger. The gold does not need to be shipped to a central authority. It remains in sovereign vaults under sovereign control. By December 2025, market fluctuations had adjusted the value of the initial reserve basket to approximately 98.2 grams of gold per 100 units. The prototype was functioning exactly as designed. The pilot is currently limited in scope, but the infrastructure being built around it is not limited at all. The coalition has agreed to construct digital payment systems, expand bilateral trade in local currencies, and develop precious metals exchanges that operate independently of the dollar system. The scale of the coalition behind this effort is what separates it from every previous attempt at monetary independence. The expanded membership now includes 10 full members spanning 4 continents. These nations collectively represent approximately 46% of the world's population. They account for 37% of global GDP measured by purchasing power. They control approximately 50% of global gold production. When the coalition members are combined with strategically aligned nations, including major commodity producers across Central Asia and the Middle East, the bloc's share of global gold output is projected to reach 65 to 70% by the end of 2026. This is not a marginal economic experiment. This is the largest coordinated effort to build dollar alternative financial infrastructure in the history of the modern monetary system. The gold accumulation strategy supporting this infrastructure has been visible in the data for years. Central banks within the coalition purchased over 50% of all gold acquired globally between 2020 and 2024. In 2025 alone, coalition-aligned nations added approximately 800 metric tons to their reserves. Combined gold holdings now exceed 6,000 tons across the full membership. The largest holders within the coalition maintain reserves of over 2,000 tons each. Several member nations have doubled their gold allocations as a percentage of total reserves in the past 5 years alone. Poland, a nation closely watching the shifting monetary landscape, approved a plan in January 2026 to acquire 150 additional tons. The stated objective is to bring gold to over 30% of total reserves. A World Gold Council survey conducted in 2025 found that 73% of central bankers globally expect the dollar's share of reserves to decline further over the next 5 years. The institutions managing sovereign wealth are not debating whether the shift is happening. They are debating how fast. The dollar's share of global foreign exchange reserves has already fallen from 72% in 2000 to approximately 56% in the second quarter of 2025. That is the lowest level recorded in 3 decades of IMF data. This decline did not happen overnight. It happened steadily, quarter by quarter, year by year. Each quarterly report from the International Monetary Fund shows the same directional trend. The movement is not random, it is structural. Meanwhile, gold's share of central bank reserves has risen from 10% in 2000 to over 17% in 2025. The reallocation is a mirror image. What is leaving dollar assets is flowing into gold and alternative instruments. The coalition is not merely accumulating gold as a passive store of value. It is integrating gold into active settlement infrastructure. The unit is the mechanism that connects the gold in sovereign vaults to the transactions flowing between member economies. This is the critical distinction that most analysis misses. Previous attempts at dollar alternatives were about holding different currencies. This initiative is about building different infrastructure. Currencies can be devalued, frozen, or sanctioned. Infrastructure, once built, operates independently. While the unit addresses trade settlement, the broader payment infrastructure being developed addresses everyday financial flows between member nations. A decentralized payment messaging system is being built to facilitate both retail and wholesale transactions. The system is explicitly designed to function independently of Western-controlled clearing networks. Multiple cross-border payment pilots are already processing significant transaction volumes between member nations. China's cross-border interbank payment system now connects nearly 5,000 banking institutions globally. In early 2026, a major African bank became the first on its continent to link directly into this system, enabling direct settlement without dollar intermediation. New precious metals exchanges have been announced where physical gold, silver, and other commodities can be traded directly between member nations, without any dollar involvement. The parallel infrastructure is not a concept. It is operational. Given the pace of development, analysts have outlined 3 potential trajectories for this initiative over the coming decade. Each is grounded in the current data and historical precedent. Scenario 1 is the optimistic outcome from the perspective of the existing system. In this scenario, the pilot remains limited. Internal disagreements slow implementation, and the dollar's structural advantages prove too entrenched to overcome in the medium term. The unit remains a niche settlement tool used for specific bilateral transactions, but does not achieve the scale needed to meaningfully alter global reserve composition. The dollar's share of reserves stabilizes above 50%. This scenario requires that the fiscal trajectory of the United States improves significantly, that confidence in dollar-denominated assets is restored, and that the coalition's internal divisions outweigh their shared incentive to diversify. Historical precedent suggests this combination is unlikely. Scenario 2 is the baseline projection, and the unit and its supporting infrastructure reach operational maturity by the late 2020s. Trade settlement between coalition members increasingly bypasses the dollar. The dollar's share of global reserves continues its measured decline, falling below 50%. Gold's share of central bank reserves rises above 20% globally. The transition is gradual but directional and irreversible. Purchasing power erosion for dollar holders accelerates as structural demand for the currency weakens. The adjustment is uneven and disproportionately affects those without diversified holdings or access to alternative stores of value. This scenario mirrors the trajectory of the British pound from the 1940s through the 1970s. The infrastructure was built over decades. The transition was visible in the data long before it was acknowledged in policy. Scenario 3 is the accelerated outcome. A confidence disruption, such as a failed treasury auction, a sovereign credit downgrade, or a rapid scaling of the alternative settlement network, triggers an accelerated shift out of dollar-denominated reserves. Multiple central banks move simultaneously to rebalance their portfolios toward gold and coalition-aligned instruments. The dollar's share of reserves drops sharply within a compressed time frame. In this scenario, purchasing power comes under extraordinary pressure for anyone holding primarily dollar-denominated assets. The historical record shows that every accelerated monetary transition concentrates its cost on those who recognize the pattern last. The documented record of monetary transitions across 5 centuries is consistent on one point. The cost of transition is always distributed inversely to information and access. Those who reposition early preserve purchasing power. Those who wait absorb the adjustment. The German currency crisis of the early 1920s eliminated middle-class savings within months. The British currency adjustment of 1967 reduced purchasing power for citizens, while institutions had repositioned years in advance. The pattern has never varied. Regardless of which scenario unfolds, several structural realities are already established. The unit prototype is operational. The gold accumulation is measurable. The payment infrastructure is under construction. The coalition's economic scale is sufficient to sustain an independent system. The Federal Reserve balance sheet expanded from under $1 trillion in 2007 to nearly $9 trillion by 2022. Each intervention was described as temporary. None were reversed. The debt now exceeds $38 trillion, growing at over $8 billion per day. Interest payments on this debt have crossed $1 trillion annually. The CBO project's debt reaching 120% of GDP by 2036. The structural mismatch between revenue and spending is widening, not narrowing. These fiscal realities are precisely what is driving the rest of the world to build alternatives. The coalition is not acting on ideology, it is acting on arithmetic, the same arithmetic that has governed every monetary transition in recorded history. The dollar is currently embedded in 88% of all international currency transactions. Dollar-denominated obligations outside the United States exceed $13 trillion. Central banks hold 58% of reserves in dollars, down from 73% 2 decades ago. A disruption at this scale would propagate through every connected economy simultaneously. The interdependence is total, and the builders of the alternative are not slowing down, they're accelerating. The documented record spanning 5 centuries converges on one conclusion. These cycles are structural, recurring, and measurable. The variables change. The sequence does not. Dominance enables the rise. Success erodes the advantage. Overextension accelerates the erosion. Obligations compound beyond growth. Confidence weakens. Alternatives emerge. The transition begins. Every central bank currently accumulating gold at record pace has access to the same data presented in this analysis. The question is not whether they see the pattern. Their purchasing records confirm they are already acting on it. The financial disruption that began in Thailand in 1997 and spread across 4 continents within 18 months involved a single regional currency with limited global exposure. The dollar is not regional. It functions as the operating infrastructure of the entire global financial system. Every trade route, every supply chain, every international contract is denominated in or passes through it. A disruption to the operating infrastructure does not affect one participant. It affects every participant connected to it. In the current system, virtually every economy on Earth is connected. The builders of the next monetary framework are not theoretical planners. They are engineers and central bankers deploying live systems across sovereign networks. Digital settlement systems are in active development across more than 130 countries. Sovereign gold reserves are being accumulated at the highest sustained rate in 6 decades. Central banks are not merely purchasing gold on open markets. They are repatriating physical reserves from foreign vaults back to domestic storage facilities under sovereign control. The architecture of a new financial order is being assembled in real time. The blueprints are public documents. The investments are quantifiable. The timeline is accelerating with every quarterly data release. The relevant data is published by the Federal Reserve, the Congressional Budget Office, the World Gold Council, the Bank for International Settlements, and the International Monetary Fund. Every indicator discussed in this analysis comes from their public reports: the trajectory of the debt, the pace of reserve diversification, the growth of alternative settlement systems, the declining share of dollar reserves, the rising share of gold. It is all published and all measurable. The information is not hidden. It is simply not widely understood. The distance between what the data shows and what the general public believes grows wider with every quarterly report. 100 digital tokens backed by physical gold were minted on October 31st, 2025. A prototype, a pilot, a test run. But the infrastructure behind it spans 4 continents, 10 nations, and 46% of humanity. So the question is, if the nations controlling half the world's gold supply and nearly half its population are building a new settlement system from scratch, what does that tell everyone still operating exclusively within the old one? The data is clear, the patterns are repeating, and the clock is ticking. Stay informed. There's another dimension to this shift that deserves close attention. It is happening simultaneously in the energy markets, and it strikes at the very mechanism that has sustained dollar dominance for half a century. Since the mid-1970s, the dollar's global role has been anchored by one arrangement above all others. International energy transactions were priced exclusively in dollars. This created compulsory demand, regardless of any nation's opinion of American fiscal policy. If a country needed oil, it needed dollars first. The single mechanism sustained the dollar's position for 50 years after the last link to gold was severed in 1971. It was the replacement anchor. That exclusivity is now ending. Saudi Arabia has begun accepting alternative currencies for energy exports. Major bilateral energy deals between coalition members now settle in yuan, rupees, and other non-dollar instruments. The combination of the unit for trade settlement, the payment system for financial flows, the precious metals exchanges for commodity trade, and the energy agreements for resource transactions creates something unprecedented. It is a comprehensive, parallel financial architecture. No single component would be sufficient on its own. Together, they form a complete alternative ecosystem that can process transactions from commodity extraction to final settlement without ever touching the dollar system. Each new bilateral agreement adds another node to a network that functions independently. Each new exchange adds another settlement venue. Each new payment link removes another dependency. The process is cumulative and accelerating. The question is no longer whether the alternative infrastructure will exist. It already exists. The question is how quickly it reaches the scale needed to fundamentally alter the balance of the global monetary system. The institutions that manage trillions in sovereign wealth have already answered that question with their purchasing decisions. Their gold acquisition records, their payment system deployments, and their bilateral trade agreements all point in one direction. The financial stress episodes of the past 2 decades reveal the same escalating pattern documented in the late stages of every prior monetary system. Each episode requires larger interventions. Each intervention produces diminishing stability. The financial stress of 2008 required measures described at the time as unprecedented in central banking history. The economic response to the global health emergency of 2020 required creating approximately 40% of all existing dollars within 24 months. The Federal Reserve balance sheet expanded from under $1 trillion in 2007 to nearly $9 trillion by 2022, a 9-fold increase in 15 years. Each measure was described as temporary. None were fully reversed. The pattern is self-reinforcing. The measures designed to preserve the system are gradually becoming the forces that destabilize it. The rest of the world is watching the arithmetic more closely than ever. That is why the unit was built. That is why payment systems are being deployed across 4 continents. That is why central banks are repatriating gold to domestic vaults at the fastest pace in 60 years. The arithmetic is not ambiguous. The response to the arithmetic is not theoretical. It is operational, measurable, and accelerating.